I've tested it with every kind of way you can classify a healthy or a bear market. Gap and goes don't give a shit. The win
Yeah,
rate
fair enough.
is the same if the market's above the 200-day, if it's below it. Interest rates are going up, interest rates are coming down. Literally during COVID, it did not care. It literally did not care. There were stocks that were exhibiting a gap and go in February of 2020.
Welcome back to the China Shop, home of the Band of Traders podcast. Last episode, Cam showed Joel how he manages his trades, but today is all about the gap and go, a momentum strategy that's perfect for growing small accounts. And it's built around stocks, so it's accessible to everybody. If you've ever watched a stock go up and thought, oh, shoot, I missed that one, then keep listening, because the gap and go is how you hitch a ride.
So, yeah, I guess today we wanted to go over a different strategy. It's the gap and go strategy. So we can walk through, I'll talk through like kind of where this came from, because I think that's very relevant and what it's used for, and just kind of like quickly go through the rules of it, like high level, and then we can get into the details and go through a couple and whatnot. So,
Perfect. Yeah.
The original idea with this strategy was, if you look at something like Fly W here, so this is a recent gap and go trade. The problem that I was having was, so I'd identify a setup, and actually here's even a better example on the same chart. I'd identify a 5-rule setup, something like this, right? Like, so we have price support here, we have a diagonal, higher lows, clears the 200-day, okay, but maybe we didn't want to take an entry here. Maybe we're going to wait another day, and then the next day it gaps up.
Right.
And so,
okay.
At open the next day, you're looking to see like, okay, is this going to cross my level? Or like, up here, if you're looking to clear this flat top, you're looking to say, okay, if price closes above this level, I'm going to take an entry. The problem being, you find this really good candidate and you're watching it and it's a great setup. And then something happens. Maybe it's earnings, maybe it's just news overnight, and the stock gaps up on you 15, 20%. And so you're left with kind of two decisions. So one, you just skip the trade because you don't want to chase it. And that has been for a long time, has been and was my instinct. And for most people, I think that's right? Like if a trade goes without you, it just goes without you, move on to the next one.
And that's what I've done as well.
Yeah, just do
So
that
it
because you don't want to chase it, because psychologically that gets into this fear of missing out. And it's a little bit of an emotional decision. You start panicking and saying, okay, well, I have to get in now. And then if you do that, instead of passing, now your risk metrics are way off. Because where's your risk, right? Like, do you risk the bottom of the gap? I mean, if that's, 15, 20, 30%, now you can't really take any size, right? Because if you're risking 30% on a single trade, how much size are you actually putting on it? Not enough for it to be meaningful.
And before that gap, my risk was at the previous low.
Yeah.
And now we've got this gap.
Yeah. And now you've got this gap.
Now we're changing risk settings that is outside of the scope.
Yeah, exactly. And that's not what you want to do. But in looking at these, I was thinking, okay, well, I'll just skip these trades. Like when that happens, I'll just skip it. But I noticed in certain market environments, a lot of things are gapping up. Like it's kind of depending on the market environment and what's going on, and I noticed this during COVID, a lot of things gap up. Like everything is gapping up. Like I'm missing all these setups. Like I'm not just missing one or two, I'm missing everything. So I started looking around to try and find a way to systematically find entries into these trades. And this is something I've been working on for a long, long time. And it's only really been the last 7 or 8 months that I've gotten it nailed down into what it is. And so that's where it comes from. Like it's still built on the 5-rule principle. Like you're still trying to identify trades the same way, looking for good candidates that are showing momentum, and then you look for a breakout. This strategy, however, lets you find names that do have that gap up and still play it with a very tight risk setting.
And so all of the trades that you find are already qualifiers for the 5 rules, or they don't necessarily have to be. They can be, a different looking chart.
So originally, they had to already be qualifiers for the 5 rules. That was where I started. So it had to meet all those same criteria. So I was just basically using the same screener, the same rule set. It's just, okay, the entry criteria becomes different. Like there's like an add-on for the entries. But in, building out the strategy and doing the back testing, I had the idea, well, what if I just get rid of the 5 rule criteria? Because I found something that really, really worked with the gap and go. So kind of spoiler alert, I found a strategy just using shares, just using, going the gap and go strategy. I found something that back tested and, bootstrapped Monte Carlo simulation, across 12,000 trades. You get about 130% return per year. It's like, okay, well, let me just throw out the 5 rules and see if that even matters. And when I threw those out, the strategy got even, the performance now is about 160%. Even Monte Carlo doing the simulation and everything.
And that gives the same opportunities, same number, or way more? Or
I would say probably less opportunities. It's more selective now, but they're better quality, and that's kind of the whole point. Like we don't have. There are a couple of different filters I'll go through, and like I'll pull them off, and you can see how it changes. You can tweak them a little bit, and you'll get a lot more candidates. But the idea isn't more, right? Like we're not trying to find more trades. We're trying to find better trades.
Yes, 100%.
Because that's one of the things that we can get into when if you're running this strategy for a small account, you can get into a situation where like, hey, the market's really strong and a lot of things are gapping. I think yesterday, for example, there were 26 candidates at open, like 26 potential trades. Like, well, you can't take all those. Like, there's no way you can take all those, even if you're using an AI system or an algorithm or something, which I have this now plugged in and running on an AI agent. Like, that's not the solution. The solution is better trades, not more trades. So I'll pull up the screener here. And so so people can actually see basically how it works. So the strategy is built on the Russell 3000. That's the first thing. Okay. You can absolutely use this on any index, on any universe of stocks. If you wanted to use SPY or just the whole New York Stock Exchange, you could absolutely use that. I use the Russell 3000 because that's where the data comes from. I have 10 years of daily price action for the Russell 3000. So that's where I'm going to play. Okay. I'll talk through the filters first.
So that narrows it down to 3,000 stocks right off.
Yeah, approximately 3,000. Russell 3000 is not actually 3,000 stocks, but
okay.
Yeah, it's actually not.
Well, fair enough.
The S&P 500 is 500. The Russell 3000 is actually not 3,000.
Oh, okay.
Yeah. And so what we're looking for in the Russell 3000 here in the pre-market change column, you're looking for names that are up at least 8% or more at open. So from yesterday's close through today's open, you're looking for names that are up 8% or more. We are looking for these candidates. In the past, it was like, I wanted to try and avoid these. And if it happens, how can I play it? This strategy says, no, we want to find them. And the reason is it's showing momentum, right? That's what trading is all about, momentum.
Right.
So we're looking for stocks that are showing momentum. And the bigger the gap, the better. A 10% gap is the technical threshold, but like you can use 8% because lots of times if something's up 8% at open, well, it might have been up like 12 or 15 10 minutes ago, right? Like it made it just pull back just a little bit going into the open. The bigger the gap, the better.
And so is that how you filter them? Say you have 2 trades. If one is gapped 59% and the other at 25 and both of them are qualifying candidates, you take the 59?
Yeah. Yep. Absolutely.
Perfect.
Because the bigger the gap, the more the momentum. And that's, as traders,
easy.
That's what we're looking for. I'll show the chart. I'll pull up some of the strategy here in a little bit and I'll walk through what I think is the most important chart in trading, like the single most important metric in all of trading. And it shows exactly why this strategy works and why it's momentum that we're looking for. So that's the first thing we look for. Okay. It's real simple. Russell 3000, 8% or more at open. Okay. The next thing, you want to go for market cap of no more than $25 billion. The strategy says $2 billion. So it's calling for small and micro cap stocks only. Okay. These are teeny tiny companies. I use 25 just to get a little bit bigger pool. it doesn't actually change the results quite so much. I just like to use 25 billion, but 2 billion is what the strategy is built on.
Okay.
The next thing here, I have to explain this a little bit. So the simple moving average 20-day is greater than the simple moving average 21-day. Essentially what we're looking for is the 20-day moving average needs to be going up. Price needs to be above it, and the 20-day moving average needs to be going up. So that is also a sign of momentum. The 20-day moving average is going up and price is above it. Okay.
Yeah.
This one here is float. So this is the number of shares outstanding, the number of shares available to be traded on the market. This is the first optional filter. You can take this one off. And if you do, you'll get more candidates.
Okay.
But the filter is 100 million shares or less. And here's why. The idea is if you find a name that is showing really strong momentum, the theory is that the market is wrong. Okay. The market has been pricing in this company, for example, FlyW, and it's had it somewhere around $13. Something happens, a catalyst, regulatory change, war breaks out, earnings, merger, new product, something. And now the market says, oh, we're wrong. This company is actually worth much, much more. We need to take a bigger position in this company. Well, if that's the case, and there's less than 100 million shares available to be traded, that doesn't necessarily create a short squeeze, but it means there's not a lot of supply and the gap is showing there's a lot of demand. So it's creating a structural imbalance. The data really strongly shows that when float is less than 100 million, the probability that the stock moves 300% or more in the next 30 days, not in the next year, in the next 30 days, it's a triple, is really, really significant. It's only like a 5% chance, but if you take the filter off, it's like a 0% chance.
Oh, fair enough. Okay, so float is the number of shares outstanding.
Yeah, so that would be the next thing.
Available.
If you were looking at two potentials, and one of them had a float less than 100 million, and one of them had a float of greater, you go with the lower float. So always go with lower float, always go higher gap. And if you had a choice between the two, lower float wins. So if one is up 50%, but it's got 300 billion shares, another one's up 20%, but it's got 5 million shares, 5 million shares, where you go. Go for the low float.
Gotcha. Okay. Perfect.
Yeah. Yeah. Any questions on that?
No. The only thing I wondered about was the difference between volume and float and how you use them. And float is there, and I think volume's probably coming.
Yes.
As we get into this.
Yeah, volume is coming.
Yeah. Perfect.
So you have your candidates. It's up 10% or more. Where was FlyW? Where was the entry on FlyW? Here, I know INOD. This was one today. So we'll go with this one. I know this was one today. This is a trade that the algorithm took. So we're in this trade. So here was the closing price yesterday. Here was opening price today. So you have your 5% gap overnight. You have your greater than 8% gap overnight. Cool. Market cap is less than 25 billion. Cool. Float's less than 100 million, and the 20-day moving average is going up. Okay, so you have your candidates, and you say, okay, I'm going to look at INOD. How does the strategy work? Very simple. You wait for the first 5-minute candle to close. So this is the time frame, 5 minutes.
Yes.
You look at the first 5-minute candle, and you take the high of that candle. That's your entry. When price breaks the high of day, you enter the position. Your risk is the low of day at whatever point it breaks. So if it's the very next candle, then your low is the low of the 5-minute candle. If it like hangs out for 30 minutes or 45 minutes and maybe dips down and then comes up, you still use the absolute low of the day. Your entry is still the top of that 5-minute candle.
And we're going in full size.
Full size. Size, the base size is 10%. So 10% of your account. If you've got, $1,000 in your account, you buy $100 worth of shares. $10,000 in your account, you buy $1,000 worth of shares. This is also built on shares, not options. You can do options with it if you wanted to. I'm not going to talk about that because that changes things, but just shares. All of the metrics in the strategy are based on shares. Okay. So that's the entry. If at any point it goes below low of day, you're out. No waiting for a close, no nothing. Below low of day, you're out. Now, look, if you want to give it a couple of pennies, that's fine, right? Like this one is $73, it looks like. So if you wanted to go like 72.97, that's fine, because, sometimes depending on your brokerage, one brokerage may say, this candle, the low was 73, one may say 72.98, one may say 73.03. So like, it's not a big deal. Like a couple of pennies is not a big deal.
Right. Okay.
So 10% size. So if you look at the size of this opening candle, it's 11% approximately. So I know some people here like, oh, you're putting 10% of your account in one trade. Yes, but if you get stopped out, what is 10% of 10%? It's
1%.
It's 1%. So your loss on the account is 1%. For most traders, that is an acceptable level of risk, 1% per trade or less. Again, if you look around and do research, that pretty much what people will tell you is stay below 1%, maybe 1.5%, depending on your size.
Yeah. I know in futures, guys would say like anywhere 1 to 3.
Yeah. So
you're right in that ballpark.
Exactly. So, you're thinking like, oh, 10% size sounds like a lot. But in general, the average size of the entry to stop is about 6%. So even if you're risking 10% of your account per trade, your average loss is like, 0.6%. Like it's a little more than 0.5% loss. So it's a manageable strategy. Why is that the stop? Because if it goes below that low of day, now where is it? It's in a gap. And if you trade long enough, gaps get filled. So if price gets sucked back down in here, there's a very good possibility that it go all the way back down the gap. We don't want to play with that. We want things that open and then just go. And that, again, that was the impetus behind me taking this strategy. Was I saw so many trades that just like they gap on me. I'm like, okay, well, I'll wait. I'll just wait for it to pull back. And it doesn't pull back. It just goes
never to return.
Never to return. And it's like, damn, why can I not find those? Yes, you can. That's exactly what this strategy is trying to find. The win rate is less than 50%. Okay. It always has been. This is not a, 75, 80% win rate strategy. I don't know if there are any 80% win rate strategies that I've ever seen. Win rate's about 40, 42%. So accept that. You're going to lose more than you're going to win. Today's a perfect example. Took 2 trades. One of them hit. INOD is one we're still in. Here was the entry here. Still in it. So from there, the next logical thing is, well, when do you take profits? So let's put it on here. Just built this yesterday. So profits, you based on your risk. So the low is $73. I'm just going to put this up here and then I'll walk through the levels.
Certainly.
Okay. So there we are.
Yep.
So here's our entry. Here's our stop. Here's your profit levels. So the profit taking levels, the first one is 3R. The profit levels are measured in risk, multiples of your risk. Risk is defined as the distance from your entry to your stop. That never changes. So when you enter a trade, in this case, it's what? 81, let's call it 81.5 to 73. So that's $8.50. Your risk is always a multiple of 8.5. Your first profit zone is 3 times your risk. So 3 times 8.5. That's where you sell your first profit. The next one is 5. After that, I believe it's 10. And then here it says on the, the indicator that we're using here, the first sell is 10%. The next sell is 15. The next sell is 20. After that, it's 20R and you sell 25%.
And so did you build this thing? You built this indicator?
My AI agent built this.
How do we get it?
So it's in the room.
It is in the room? Okay, perfect.
It's in the room. Just download it if you want to run the strategy, because this becomes, I think, the most difficult part with the strategy. It's the profit taking, because it's not just like when you're up 10% or 5%, you're not going by levels on a chart. This is what was optimized in the back testing. I went through a lot of different versions. I looked at just a straight, every 10% you sell 10%, or every 15% or whatever. tried going off of chart levels. The best thing is just to measure things based off of risk. And for newer traders or people who are struggling, I like that because it gets you thinking about risk. It keeps you thinking always about risk. That's how you survive as a trader. Right. Like,
Yeah.
and the goal is survive until it clicks. And then once it clicks, you still think about risk, but I promise you, it won't click until that risk thing is just in your bones. When you stop thinking about risk, you start losing money.
100%. Yeah.
The analogy I like to use with people is like, it doesn't matter how fast you pour water into a bucket. If the bucket's got holes in it, it's real hard to fill it up, right? Like, and the more holes you have in your bucket, the worse you're leaking water, the harder it is to fill it up. The easiest way to make money as a trader is to stop losing it. Is to focus on your risk.
So true. Yeah.
So
I see on there, there's prices. So that's just the price that it's at. So that makes it easy to set your bracket orders.
Yep. There you
Because
go.
then you can just go right off of that.
Yeah. So once you enter the trade, you just go in, type in your order, limit, what's the first price point? 107.64, boom, and you're done.
And so then I see there's a percentage on there too.
That's percent of your account. So the first profit target, you sell 10% of your account. All of the percentages are of your original position. So not of your account or like 10% of what's remaining. They are of your original 100%. So
gotcha.
Yeah. So you set the orders from the beginning, as if you had 100 shares at the get-go, you would sell 10 here, 15, 20, 25 if it gets to 20R, and then you always leave a runner of 25%.
Lovely.
As long as possible.
If there's structure nearby, if the stock had come down and now it's on its way back up, if there was structure nearby like that, are you adjusting those or that you just leave it?
Yep. Just leave it.
The strategy was tested that way. You just leave it that way. Okay.
Yeah. In practice, I'll be honest, if you get to a big point on the chart, here's all-time highs. Like, here's all-time highs. Look where it rejected today, really close to all-time highs. If you want to pull some off there, I understand it. Pull a little bit off. Yeah. But, if there's a gap on the chart, right? Like it's running and then it gets to an area where there's a real big gap. I get it. As an experienced trader, you should know, or hopefully you'll learn, that when price is entering a gap, the first time it gets there is a good chance it's going to reject it. You don't know how low it's going to go. So always better to take a little bit off there and then, work with it. So if you do want to go outside of the strategy, I'd keep it small. But yeah, if you want to pull a little bit off just to help you feel a little bit better, that's fine. Just know that the results from the back test are based on purely following these rules. And it's agnostic to the chart or the market environment or anything like that.
Right. Okay.
So with that, your stop stays at the low of day until you take your first profit. Once you take your first profit, your stop goes to break even.
Okay.
Goes to break even. After day 3, if you're in the trade for 3 days or more, the stop switches to a 10% trailing stop. So if it drops more than 10%, out. Okay. So again, when you take your first profit, stop goes to break even. Okay. After day 3, so like in the first 3 days, you're not using a trailing stop. Your stop goes to break even. And then in the first 3 days, if it turns around, just let it go. Because the best trades in the first 3 days have a really strong probability of just ripping. The most volatility is going to occur likely in those first 3 days. And if you think about it, especially in small and micro cap stocks, right? Like Apple doesn't move 7 or 8 or 10% very often. Like a small cap stock, that's just like lunch. Like they just move 7, 10% because we're looking at stuff with low float. We're looking at stuff with low market cap. These are things that have been mispriced and they're experiencing a sudden surge in buy volume. They're volatile. So the first 3 days, you need to give it room to move around and not get too quick on the trigger. So first 3 days, once you take profits once, just move your stop to break even. If it comes back and you get stopped out, you get stopped out. Okay.
Fair enough. Like this one here, if you go back to the 5 minute, I think it retested your entry today, right?
Yeah.
Yeah. So you wouldn't want to bring it up too soon because then
No,
now you're
get
kicked
stopped
out. Yeah.
Yeah.
100%. Okay.
Yeah. So a little bit. So I originally, when I was running this strategy and I built it, I was taking profit at 1R. So 1 times risk, I'd go ahead and sell like 5 or 10%. I wouldn't move my stop up yet, but I'd go ahead and sell a little bit for the trades that really run, that end up really ripping. That actually costs you a lot of money. Like it makes a material difference in the annual performance of the strategy. That's why, my version was like 120% return per year. This one is sitting between 150 to 160%.
Right.
So,
Okay.
and that may not seem like much, but that's an extra 30 or 40% a year. Like that's the difference between just into the market. Like that's a big difference.
The rest of us are shooting for the S&P 500 10% a year, right? You're talking 4 times that return.
You can sell puts and beat the S&P 500. Okay, so there's one other piece that comes into play here.
Yes.
At the end of the day, so the bell happened perfectly. At the end of the day, or in the last, to be honest, in the last 15 minutes, you look at the volume for the day. This is the last tweak to the strategy. If the volume for the day is greater, or specifically 5 times greater than the daily volume for the last 14 days, you should be able to see here on the chart, this is a huge volume candle. Significantly greater than really anything ever for this stock. You use a wider profit-taking regime. So in the strategy here, I have the settings, volume confirmed 5x. So now you use a wider profit-taking schedule. Your first profit target now is 5R. Your second is 10. Your third is 20. Your fourth would be 50R. And then you leave still a 25% on as a runner with a 10% trailing stop. Okay.
Yeah.
So that's the other tweak. One other point of clarification. I missed it. If you added up the percentages, you caught it there. On day 3, you always sell 5%. At the end of day 3, sell 5%. Because that's when you switch to a trailing stop. So even if it hasn't hit your first profit target, you sell 5%. So you're moving to a trailing stop. You're going to lock in hopefully at least 5%. So in case it just hangs around and is slow to get out the gate. So yeah, the volume modifier, there you go.
So no matter where it is on day 3, even if you've hit 5R and 10R on day 3, you're still going to take
5%.
5%.
Yeah, if it doesn't hit a level on day 3, you're taking 5%.
Gotcha.
I lied. There's one other modifier here. The float criteria. I mentioned you don't have to use this. This is optional. If the float is less than 100 million, you size up to 15%. So you increase from 10% of your portfolio to 15. So those are the 2 modifiers for the strategy. Float being less than 100 and volume being confirmed is what it's called. Volume is 5 times greater than the last 14 days. You increase your profit-taking schedule. Float is less than 100 million. You increase your size.
Okay. And this happens to hit both of those.
This hits both of them. Yep. So these are the ideal trades. These are the highest probability that they will hit, again, 300% in 30 days. That was what I was trying to capture. A stock that has extreme momentum. I'm not talking about 300% over a year. That's great for a swing trade. And those are great trades. That's not what this strategy is for. This is for the extreme momentum names.
Gotcha.
And that's why it's tailored to small cap and micro cap stocks. Because again, Apple's not going to move 300% in 30 days, right? But a small cap stock here that's only, it's only 20 or 30 million in market cap. Yeah, they get a partnership with NVIDIA. Oh yeah, you're going to add zeros to the market cap, right? It's going to rip. That's what you're looking to try and find. Something like that.
Gotcha. Yep. Okay. Funko Inc.
Yeah. What was it? FNKO? Funko. Yeah. So this was one. Let's see. I saw it hit the watch list this morning. So yeah, this one would have triggered. So there was your opening 5-minute candle. So it would have triggered. You'd still be in the trade. It never hit low of day. So you'd still be in. Okay. And again, win rate, it's not great. It's about 42%.
No.
But the profit factor on the strategy is, I can throw this on here if we want to talk through it. The profit factor is over 4. So for every $1 you lose, you make 4. So that means as long as your win rate is above 20%, you're making money.
And you're at 40-ish, 42, you said, or something, right?
Yeah. So that gives you a pretty good compound growth. Again, I'm running this. I have enough confidence in this that I have this in an account that has an AI agent running it. It's with real money. I just check it every day, debugging it, making sure everything works. We're going to let it go and see what it does. This week, I think the account's up 7.5%. I didn't click a button. Like it's doing everything. I didn't click a button. It's up 7.5%. And yeah, I mean, I've posted some of the trades. I mean, they're up 68%, 29%, 21%, 16%, 10%, 6%, 5%. And yes, some have been stopped out. That again, there were some that stopped out today. So here was one that didn't work out today. AAOI stopped out. So here was the opening 5-minute candle, broke the range there, and then didn't last very long, stopped out, took a full loss on the trade. Move on. Next.
Exactly.
So, but I think this chart is a good example of typically what happens with the strategy. When it breaks this range, this is what it does. It doesn't like break it and like hang around and come back. Like, no, if it loses that gap, what does it do? Pretty much goes back and fills it. Pretty much fills the gap up.
Yeah. Okay.
So what else did we want to go through here? So portfolio selection, like how does this fit in like a bigger picture portfolio? So the position sizes are anywhere between 10 to 15%. So at most you can take 10 positions because that would be 10 trades at 10%, but you want those 15%ers. So, because those are, the better quality trades. So if you're running this in your entire account, you're going to be sitting somewhere between a maximum of 6 to 10 trades. You will get to a point where you have to do selection. So let's say you've got 5 trades on and you're looking at, a day like today where, there's several that are here. There's over a dozen. Which one do you pick? Well, so I'll pull the strategy over here in just a second. You can look at the scoring criteria, or you could just go by the things we talked about. So looking at the trades that you're in, which one is performing the weakest? So if you have 5 trades that you're in, which one is up the least? That would be the first one to pull out, right? Like, so if you're in 5 trades, so, I'm looking at, the best performing one right now is up 68%. So we're going to keep that one because it's working. The worst performing one we're in is up 4%, PRG. This is one from a couple of days ago. PRG. So here was the gap. There it is. And actually, on the daily, that looks pretty good. If it could break this, it looks like it'll rip. But this would be the one that we'd cut. If we have another one that came along, INOD, then I would pick INOD and I'd cut this one. Okay. Because this was only up 3%. This one is showing me low float. It's up, 50, 60% at open. We don't know it's going to be a volume confirmation at open, but it meets the criteria. Good gap at open, low float. Yeah, if I have to take one, I'm going to take that and I'm going to pull the weakest one off.
Yeah, there's kind of a mentality thing here too, where you're never holding dead trades. You're not going to hold something that's down 2, 3, 5, 8, 15%.
No, it goes against you. The momentum's gone. Get out of it.
Just by its nature, it's going to get cut probably day of, or like soon after, right?
Yeah. KFRC. So this is a good example of one. This was a gap and go, was up. I forget how much this one ran. A good like 30 or 40%. It actually stopped out right here because it was down more than 10%. It ended up being down, right here. It stopped out right at the end of the day. Yeah, it hit a 10% drawdown. So stopped out there, but then I kept it on my radar because, hey, it's a big gap up, but it's showing me a consolidation. It gives us this daily candle here, another day, and then yesterday, higher low, higher high. I'm back in the trade today. So again, this was the original idea behind the strategy. find something that gaps up, shows you momentum. Hey, I've got some money in the bank. So as far as the P&L shows for this trade, I got in, right around here, made some money. I did actually take profits up here, stopped out with money in the bank. Now I'm back in the trade. My low of day is here. So like, even if I get stopped out again on this trade or on this name, I've already made money. And this is the original idea. Hopefully this is what happens. It runs, gives you a little pullback, and then gives you a second leg. So that's the strategy, kind of doing what it was originally intended on doing. But yeah, to your point you're making, you're not hanging around. Like if it runs and then it starts to die, you're out. That's not what we're looking for. We're looking for things that are just going to go. So a good example would be MXL. So here's a good example. It gapped up just after earnings, and then the next day got stopped out because it crossed below the low of day, and we never took profits. Stopped out of the trade.
Right. Yeah.
2 days later, we get another gap up, back into the trade, and here was the entry, and this is the one that's 30%, and we've hit 2 profit targets. So that's the
10 days.
It just runs.
Ish.
Yeah. On shares, and then if you look at the volume, look, it's increasing volume on the way up. We've been in the trade for a week, and look at this big candle we got today. This is what we're trying to find. And now we're into a point where it's a trailing stop. And I have the alert set here too, just in case.
Yeah.
So this is a good example of what we're trying to find. The other piece with this is I've tested it with every kind of way you can classify a healthy or a bear market. Gap and goes don't give a shit. The win rate
fair enough.
The win rate is the same if the market's above the 200-day, if it's below it. Interest rates are going up, interest rates are coming down. Literally during COVID, it did not care. It literally did not care. There were stocks that were exhibiting a gap and go in February of 2020. Now, for my back testing purposes, I always exclude COVID. I always exclude 2020 because nothing that happened in 2020 is normal. I don't think anyone should base anything on what happened that year. But even when I looked at the data, the results of the strategy, I think the win rate was like 35% in the first quarter of 2020. So it was a little bit worse, but even during that environment, stuff was still running. So it does not care about market environment because, again, it's momentum, right? Like if there's something that's showing momentum, it's going to rip, right? Like if a stock has been mispriced, if they've got a new product or an acquisition or whatever, the market doesn't care. The market doesn't care.
Yeah. So you did it all with the Russell.
Yep.
So that's what you use because of the back testing, but you could probably try it on other things.
Yeah, absolutely.
It's just, we don't know what the results would be.
Yeah. I would expect they would be. So there are 2 things I would say you have to consider. One, is it in an index or is it not?
Okay.
If you're looking at a name that is not in an index, I don't know how the strategy would perform. I would tend to say you're probably going to get a little bit lower win rate. Win rate's probably going to be a little lower than 40%. I'd say probably around 35. But I would say your home runs are probably going to be bigger because you're looking at names that maybe are not indexed, but again, something changes. They're not in an index. They definitely have less institutional interest, right? Because there are companies, there are pension funds that what they do is they just buy anything in the Russell 3000. So there's institutional interest in every single thing in the Russell 3000. If you're not in any index at all, there might be, like you might have some institutional ownership, but the odds are really low, right? Like an index enforces that. And institutional buying is what drives price. Retail never drives price. Institutional buying drives price. So in something that's not in an index, I would think the win rate might be a little lower. You're going to see a little more volatility. You're going to get stopped out more, so the win rate's going to be less. But that fat tail risk, like, when you hit one, you're really going to hit one. Like,
Gotcha.
the number of 3 or 4 or 500 percenters that you hit is probably going to be higher. Now, if you're looking at something in an index, another index, I would say the results are going to be fairly similar, but you have to consider market cap. Let's look at like the S&P 500. None of these met criteria today. Right? And I mean, you just go by market cap alone, how many stocks in the S&P 500 are less than $25 billion market cap? Not many.
To be honest, more than I thought.
More than I thought. Yeah, not very. I mean, yeah, we're looking at a couple of dozen here. And how many were up today? More than 8%? Very few, because it's the S&P 500.
Right.
There's already heavy institutional ownership. And then look at the price of all these. 300,
Exactly.
300, 200, 500. Whereas you go to, I mean, even the Russell 2000. Let's go to the Russell 2000. $5, $5, $2, $18, $7. And again, on the Russell 2000, what do we have? Instantly, we have a couple of dozen names.
Yeah.
But yeah,
lots similar probably.
but yeah, I would think this would work in, a Canadian market, in the European market. Everything should work because the markets function the same. Institutions in Europe buy the same way as institutions in America. They're using probably the exact same algorithms, right? Like the price action is going to move the same. I would think it's going to work. Now, full disclosure, I would want to back test it if you put it into a new market, or,
Right.
paper trade it for a little while, just see how
100%.
it goes.
Yeah.
Always do that. But in general, as long as the market has institutional actors, as long as it's, 75 to 80% or more algorithmic or AI trading, which I don't think there's a market, a major financial market that's not, this strategy should work. It can work on bigger market caps. I'll pull over the original playbook strategy that I was running. So when I was originally running this, my market cap filter was 100 billion. So I looked at stocks between 250 million and 100 billion. So I wasn't looking at the micros. I was kind of looking at small to medium sized stocks. And the profit factor was about 2 1/3. Win rate was about 40%. Again, compound annual growth, about 120%. So this can work on medium sized stocks. Like if you wanted to use the S&P 500, this would work. This would absolutely work in the S&P 500. But if you're not going to do options, and I was running this with options, so this is not indicative of my result. My profit factor with options was around like 12.
Okay. Yeah.
But with shares, again, 120% for the year, 40% win rate. So this will absolutely work in the S&P 500 or in the NASDAQ or something else if you wanted to go larger size stocks. If maybe just for some reason you're not comfortable buying, like a $50 million company or something like that. Like I understand, people may be a little hesitant there. My pushback is you're in this for a good time, not a long time. Right? Like we're not
fair
here,
enough.
we're not here to get married. Right? Like, and the average time in trade, it's like 7 days. Like you're not hanging out. Like you're here to catch the momentum. Here's the Monte Carlo. So again, 10,000 simulations. You can see the the green line versus the yellow line here. We're not hanging around here. So, and again, this is in the room, all the data here. I'm not going to go through it, but it's there. It's been back tested. I have the actual back test data. If anyone's interested in it, I will happily show you the Python files, show you the actual trade results. You can go through.
That's massive, I'm sure.
Yeah, it is. It is.
Oh yeah.
But yeah, see, here's
average hold. Yep.
Yeah. So in the volume confirmed trades, 5 days, not confirmed trades, 3 days. Okay. So yeah, average trade time is not very long. You're trying to catch the momentum. Literally, as soon as the momentum dies, you're out. But like I showed earlier, I think these stocks are a great candidate to keep on your watch list because they have shown you tremendous momentum. Maybe it's just, hey, after 3 days, and I think it's funny, the rule that I've always used with earnings is 3-day rule. The first 3 days after earnings, you don't touch a stock because it's going to be really, really volatile. Well, the average hold time on the gap and go strategy is 3 days.
Yeah.
So after 3 days, maybe it starts to pull back and consolidate a little bit. You're out of the gap and go. Now it should be on your swing trade watch list because it just showed you a lot of momentum and you made money on it. So keep watching it. See if it gives you a consolidation. If it does, hit it again. But yeah, all this is in the room if people want to look through it.
When
Again,
you ran
10,000 trades, 10,000 simulations, 12,000 total trades across 10 years.
Across 10 years. Okay. And do you find it's like you're kind of in and out daily, or is this something where you can trade, 2 to 4 days a week?
Yeah, I think you could.
And hold a little bit.
Yeah, you could definitely trade it. just when you have time. Because it's going to work, right? Like, I mean,
Right.
there are periods where it doesn't do well. I think the largest drawdown across the simulations was, it was like 40 days. So if you trade it every day, you'd be underwater for, a month and a half. Which,
Okay.
if you're swing trading, I mean, that's very common. I mean, I had 2 drawdowns this year. We're in May. I had 2 drawdowns this year of about 12%. I was underwater for a couple of weeks. That's not uncommon. But yeah, if you only have access to trade or the free time to trade 3 days a week, that's fine. The thing that is different with this is it does require attention at the open of the market. You need to be there for the open of market. And I understand with your schedule or with other people's, like maybe you only have time at the end of the market. If you only
Right.
have time at the end of the market, well, then this really isn't going to work because you need that first 5-minute candle. That's what this is built on.
Right.
So if you can find it, if you can find the time, if it works for your schedule at the market open, because again, all you really need is that first 5-minute candle. You need it, about 15 minutes before the market opens to, go through the screener, make sure you have your names, look at your portfolio. Okay, how many trades can I take? Which one am I going to kill? Which one am I going to get rid of? If I have to take a new one, understand, look at the names and say, okay, this one is $23. So know your position size ahead of time. Okay, so I have $1,000 in my account. What would that position size look like? Go ahead and do all of that, because lots of times when these things rip, they rip. When that 5-minute candle closes, you need to set your orders, like set them
Right.
and put them in place, because the best ones, like, they're going to go and they're not going to hang out. And then, but once that happens, you're good. Like, get your orders set and then, have an alert. Worst case, you're working, you get, you can't be right at your computer. You get an alert that, hey, you got an order filled. Pull up your phone, your computer real quick, and just set your set your stop order in. Some brokerages let you do an IFTT order. So if this, then that. So if my limit order gets filled, then place a stop order. Most do, from my understanding. I'm pretty sure Webull and Robinhood do. It is an advanced order. You have to know how to set up the logic there. If this, then that. I know Morgan Stanley doesn't. I know E-Trade doesn't. But yeah, if you can do something like that, all you need is the first 5-minute candle, and then you just set your order in for, if this gets filled, then low of day. Lowest price for the day becomes your stop loss. So, and then just check it at the end of the day. Check it at the end of the day, and then put in your profit targets, just a bunch of bracket orders. So you would have like 4 bracket orders plus 1 just absolute stop.
1 stop. Yeah.
The one thing that I would say, kind of the last thing that's on my mind with this is, I think this is the best way to grow a small account. All the strategies I've seen, and when I say best, I would say I define best as there are words I can't say. There are
Highest
words I can't say.
likelihood of success.
I have my Series 65, so there are words I can't say.
Yeah, that's fair. Highest likelihood of success. I can say them because I'm not telling anybody.
Yeah, the highest likelihood of success. It can be very mechanical, right? Like, I know the rules, like when you first hear them, they can be a little complicated, but they're all very hard rules. They're based on numbers. It's not like, oh, the swing low here or this candle formation, which can be very subjective, right? It's like opening gap of 8%, the high of the 5-minute candle, low of day, right? Like, these are all levels that the market gives you. You don't have to determine, is it up 8% or more for the day? The market tells you. You don't have to determine the high of the 5-minute candle. The market tells you. You don't have to determine your risk levels. The market determines those for you. The strategy determines those for you. So you don't have to make a lot of decisions with this strategy if you decide to run it. You just have to follow the rules. And like, any good trading strategy, the goal is just not to screw it up, right? Like, as long as you just follow the rules and execute it, it should do pretty well. With that, there are kill criteria in this strategy. So here in the implementation guide. So there's a general comparison, and then there's an implementation guide. So a kill criteria is, if you see something happening, if you're running the strategy on a regular basis, and one of these things happens, stop immediately. Close every trade, stop running the strategy. because something is happening that indicates this is a market environment that was not in the back test universe. Okay. That is very uncommon in my 11 years of experience. This is an institutional level criteria. Institutions use kill criteria. Retail traders typically don't even know what the hell this is. Okay. So profit factor below 1.5 over 100 consecutive trade. Win rate below 30%. 2 months of negative P&L. And this assumes you're executing it perfectly. If you have 2 months of a negative P&L, the strategy is no longer working. You need to stop and probably back test it again. So that's one of the things I really like about this, and why I say I think this is the highest probability of success if you can execute it correctly. Never know what's going to happen, right? Like a lot of things are changing now in the market. Like we've mentioned AI before. I really don't think AI is going to change anything. Like it's just going to make things happen faster, which is kind of what the Gap and Go wants, right? Like we want things to be faster. 24-hour trading, there's still going to be a cash session, right? Like it's not going to be everyone trading everything all the time. Institutions aren't going to trade all the time. I mean, futures have 24-hour or 23-hour trading right now, but after 4 p.m., like the market closes, what does volume do? It dries up, right? So we already have 24-hour trading, and that hasn't changed anything. 0-day options. I mean, we already have 0-day options on most things. That's not going to change anything. And the stuff we're looking at for the Gap and Go, most of these don't have options anyway.
No.
So yeah, at least in the near term, like this should survive everything that's going on. I think it's the best way to grow a small account. The only caveat is, again, you have to have that time at the opening of the market. If you don't, don't have time at the open of the market, if you can give me 30 minutes and some of that, at least 10 of that overlaps the opening bell, I think you can run the strategy. I think you can.
Mm-hmm. Yep.
Awesome. If you don't, then you got to go to something else. So
then we stick with the 5 rules.
Yeah.
Swing trading.
Stick there. And again, that works too. And again, that's what I like that we talked about that first, because that's really where this came from. The goal here was to get me in more 5 rule setups and just not miss the ones that were gapping. It was just another way to enter those trades. And as I started digging deeper and deeper, it was like, hey, there's really something here. So full disclosure, I did not invent this. I'm not trying to say I invented this. It's known by other names. Pratik Bondi has something very similar to this. He calls it a momentum burst strategy. Christian Kwalamagi, he's a YouTuber, right? Like he took $6,000 to $100 million. He calls it an episodic pivot.
That's neat.
There's been research going back to the 70s. There's research at, I think, 1972 to 73 around this same idea of like an overnight gap and then continuation into the morning. So this isn't something that I invented. I just pieced together other things and kind of came up with my own version, my own iteration. But it's 90%. If you look at what Kwalamagi does, like it's 95% of this. Pratik Bondi, it's 90% the same strategy.
Yeah. If you were going to give us any homework, what would you do? What would you say? Just start paper trading?
Yeah, I would say, paper trade it. Yeah, on paper, try it out. So what you could do now, set up the screener right now, and then just go through everything that met the criteria today and see how the trades played out. See which ones broke the 5-minute candle and which ones ripped. Which ones would you got stopped out? Which ones would you have won? How many of these could you have taken in your account? Work through, how does sizing work, right? Like kind of put yourself in the, maybe even start a watch and say, okay, 5 minute, the market opens. I've got 5 minutes to figure out what my position size is going to be for 4 of these trades. And, quickly, can you go through the math and say, okay, how much room do I have in my account? Okay, I could take 1, 2, 3. This one would be 10%. This one would be 15. This would be 15. So maybe go through that, just kind of walk through and see the execution. Yeah, that's what I would say. Just try it out, paper trade it. Again, it's in the room. In my room, I have a scanner that posts all of the activity for the strategy. So it lists all the candidates. If they're 10% or more, 10% size, 15% size, which ones to skip, which ones should get replaced. It's running it at the optimum level, and everything is there so you can follow along if that's something people are interested in.
That's awesome. Yeah, this has been great. Thanks so much, dude.
I hope everybody enjoyed this breakdown. If you want to dig deeper or follow along with the scanners, backtests, and research that Cam mentioned, we'll have links in the show notes to his Discord. And don't forget to like and subscribe on your way out. We'll see you all in the next one. This podcast is intended for informational and educational purposes only. It does not constitute financial or investment advice and should not be construed as such. The hosts, guests, and contributors of this podcast are not licensed financial advisors, brokers, or professionals. Any trading or investment decisions made based on the content of this podcast are solely at the listener's discretion and risk. Trading and investing in financial markets carry inherent risks, and past performance is not indicative of future results. Listeners should conduct their own research and seek advice from qualified financial professionals before making any financial decisions. The views, opinions, and information shared in this podcast are those of the individual contributors and do not necessarily reflect the views or policies of the podcast creators or associated organizations. Produced by China Shop Productions.